On the afternoon of February 2nd, 2026, silver futures contracts collapsed by nearly 14% in less than 3 hours of trading. The London Metal Exchange reported technical difficulties. Major European banking systems experienced what they described as routine maintenance interruptions. Physical dealers in 6 countries watched their order volumes multiply by factors they had not seen since March 2020. And by the time American markets closed for the weekend, the official explanation was already circulating. Over-leveraged speculators, margin compression, algorithmic instability. The story was clean. The story was familiar. The story was incomplete. What happened that Friday was not an anomaly. It was a feature. To understand why requires looking backward to a moment most people have forgotten, August 15, 1971. On that evening, President Nixon announced the United States would no longer convert dollars to gold at the fixed rate that had anchored the global monetary system since Bretton Woods. The decision was presented as temporary. It became permanent. And in that single act, the architecture of commodity pricing was fundamentally restructured. Gold and silver were no longer anchors. They became variables, and variables can be managed. The mechanism that emerged over the following decades was elegant in its simplicity. Physical metals would continue to exist, continue to be mined, refined, stored, and traded, but the price discovery process would increasingly occur not in vaults or refineries, but on exchanges where contracts could be created, leveraged, and settled without ever requiring the movement of actual metal. By the early 1980s, the ratio of paper claims to physical inventory in certain metals markets had already begun to diverge. By the 2000s, that ratio had reached levels that would have been considered structurally unstable in any other asset class. By 2026, it had become the foundation of the system itself. This is not conspiracy. This is architecture. The Commodity Futures Trading Commission has published data for decades showing that in silver futures markets, commercial traders consistently hold net short positions that dwarf the annual global mine supply. These positions are not hedges in the traditional sense. They are structural instruments designed to absorb upward price pressure in a market where physical demand persistently exceeds new supply. The same pattern appears in gold, copper, and platinum. The same institutions appear in the commitment of traders' reports year after year, holding the same side of the trade. And the system functions because most participants never ask for delivery. There is historical precedent for what happens when they do. In January 1980, the Hunt brothers attempted to corner the silver market by accumulating both futures contracts and physical metal. The price reached $50 per ounce. The COMEX exchange responded by changing the rules mid-game, restricting new purchases to liquidation orders only. The price collapsed. The Hunts were ruined. The system was preserved. 46 years later, the tools have changed, but the principle remains identical. When paper markets become stressed, the rules bend to protect the architecture, not the participants. In March 2020, during the initial pandemic lockdowns, the gold futures market experienced what traders call a dislocation. The spread between futures prices in New York and physical gold prices in London reached unprecedented levels, in some cases exceeding $70 per ounce. The reason was logistical. Planes were grounded, refineries were closed, and the physical metal required to settle contracts could not be transported efficiently. The CME Group responded by temporarily allowing different forms of gold to satisfy delivery requirements. The market stabilized, the dislocation closed, but the episode revealed a structural truth. The price printed on a screen and the price required to obtain physical metal are not always the same number. And in moments of stress, that gap becomes a chasm. What occurred on February 28, 2026, followed a similar script, but with additional layers. The initial sell-off began in Asian trading hours, accelerated through European markets, and reached maximum velocity as American traders entered their sessions. The technical issues at the London Metal Exchange were reported at 10:47 GMT, precisely as silver futures were breaching a support level that had held for 6 weeks. Trading resumed 38 minutes later. By that time, the cascade had already triggered margin calls across multiple brokerages, forcing automatic liquidations that fed the downward spiral. The banking disruptions in Europe, attributed to system updates, meant that certain participants could not access liquidity to meet those margin requirements in real time. And while the official channels were constrained, physical metal continued to trade in jurisdictions where local premiums had already been elevated for months. The pattern is consistent across commodity market crises. In 2008, during the financial collapse, gold and silver initially sold off alongside equities as funds liquidated anything that could be converted to cash. Physical premiums spiked, delivery delays extended, and within 6 months the paper price had recovered and then exceeded previous highs. In 2011, when silver briefly touched $49 before collapsing 35% in 5 days, the same divergence appeared, paper price crashed, physical demand intensified, inventories tightened. The cycle repeated in 2020. It is repeating now. The reason the pattern persists is structural, not incidental. Modern commodity markets exist within a framework where financial institutions have an embedded interest in price stability. Extreme volatility in either direction creates risk exposures that threaten balance sheets, derivative books, and hedging strategies that assume certain boundaries will hold. When silver moves too violently upward, it stresses the short positions that underpin those strategies. When it moves too violently downward, it risks breaking confidence in the pricing mechanism itself. The solution historically has been intervention disguised as technical adjustment, change margin requirements, alter delivery specifications, experience system outages at opportune moments. The effect is the same. Volatility is contained, leverage positions are flushed, and the structure resets. What makes February 2026 distinct is the context. Global inflation had remained elevated despite central bank projections. Currency debasement had accelerated across developed economies, and physical demand for precious metals had reached levels not seen since the 1970s, driven not by speculation, but by institutional accumulation in jurisdictions that no longer trusted the dollar as a reliable store of value. The paper market was being asked to perform a function it was not designed for, to suppress price while physical inventory drained to regions where contracts are settled in metal, not cash. The mechanics of this draining process are visible in trade data, though rarely discussed in mainstream analysis. In 2025, silver exports from Western vaults to Asian refineries reached a 30-year high. London vaults, which had held over 300 million ounces in 2020, reported inventories below 200 million by early 2026. COMEX registered silver, the portion available for immediate delivery, had fallen to levels that represented less than 3 days of global industrial consumption, and yet the paper price remained range-bound for months, defying the elementary principle that scarcity drives value. The explanation lies in the asymmetry between paper creation and physical settlement. Contracts can be written instantly. Metal cannot be mined instantly. And as long as most contracts settle in cash, the imbalance remains invisible until it is not. The tipping point in such systems is never predictable in advance, but it is always recognizable in hindsight. In 1971, French and German demands for gold conversion triggered Nixon's decision. In 2008, the collapse of Lehman Brothers revealed that subprime mortgage securities were not as liquid as their credit ratings suggested. In 2020, negative oil prices exposed the absurdity of futures markets disconnected from physical reality. Each time, the authorities insisted the system was sound. Each time, the system was restructured after the break. And each time, the new structure created the conditions for the next crisis. What occurred on February 28th may eventually be understood as a precursor rather than an event. The forced liquidations cleared leveraged speculative positions, but they did not address the underlying imbalance between paper supply and physical demand. The technical disruptions provided a convenient narrative, but they did not explain why physical premiums in Mumbai, Shanghai, and Dubai remained elevated even as paper prices crashed. The weekend closure of markets provided a pause, but it did not resolve the question of what happens when the next wave of demand arrives and the inventories are thinner than before. Central banks understand this dynamic, which is why gold accumulation has accelerated among institutions that operate outside the Western financial system. Russia increased reserves before sanctions made such accumulation legally complicated. China's official holdings are reported infrequently and are widely believed to understate actual accumulation. Central banks in Turkey, India, Poland, and Singapore have all increased gold reserves in recent years, often purchasing during price declines that Western investors interpreted as bearish signals. The pattern suggests a different calculus. These institutions are not trading. They are positioning for a system transition that they believe is inevitable, even if the timing remains uncertain. The mistake repeated across history is the assumption that financial engineering can indefinitely substitute for physical constraints, the belief that paper claims can expand without consequence as long as confidence holds, the assumption that liquidity can be manufactured in unlimited quantities without degrading the value of the underlying currency, and the insistence that market disruptions are temporary anomalies rather than symptoms of structural imbalance. These beliefs have been tested repeatedly. They have failed repeatedly, and yet they persist because the alternative requires acknowledging that the system itself is the problem, not the participants within it. What makes the current moment particularly fragile is the convergence of multiple stress points. Sovereign debt has reached levels that cannot be serviced without monetization. Inflation has proven more persistent than models predicted. Geopolitical tensions have fractured the assumption of stable global trade, and trust in institutions, both governmental and financial, has eroded to levels that show no sign of recovery. In such an environment, hard assets are not speculative instruments. They are exits from a system that fewer participants believe can be sustained indefinitely. The official narrative will continue to emphasize stability, resilience, and the strength of regulatory frameworks. The language will remain confident, the assurances will remain firm, but the actions being taken behind that language tell a different story. The quiet accumulation of physical reserves by central banks, the increasing frequency of market dislocations followed by rule changes, the growing divergence between paper prices and physical availability. These are not signs of strength, they are signs of managed decline. History does not repeat in identical form, but it rhymes with sufficient consistency that patterns become predictable. Currency debasement leads to loss of purchasing power. Loss of purchasing power leads to demand for alternatives. Demand for alternatives leads to price suppression through market mechanisms. Suppression creates divergence between paper and physical. Divergence creates stress. Stress creates disruption. Disruption forces acknowledgement, and acknowledgement forces restructuring. The cycle has played out in Weimar Germany, in 1970s America, in 1990s Russia, in 2000s Zimbabwe, and in 2010s Venezuela. The specifics differ. The sequence does not. What remains uncertain is not whether the current system will restructure, but when and how orderly that restructuring will be. There exists a narrow possibility that policymakers could choose gradual adjustment over abrupt collapse, that inventories could be rebuilt before confidence breaks, that paper markets could be recalibrated before the divergence becomes unmanageable, that transparency could replace opacity before the next dislocation forces change. These outcomes are possible. They require acknowledgement of the problem, which requires overcoming institutional inertia, political resistance, and the deeply embedded incentives that benefit from the current structure. History suggests such reform is rare, but it is not impossible. The events of February 28, 2026 will likely be remembered as noise or as a footnote, unless they are later recognized as the moment when the pattern became undeniable. The price recovered, the weekend passed, the markets reopened, and the system continued functioning exactly as it was designed to function until the day it no longer can.